Thank you very much for joining us. And this is Tricio's 2025 Outlook Investing in Trump's World. Now, John's going to lead off as usual. John Calverley, our chief economist. He's got many years of experience and he's ducked and dived through the previous Trump administration. So I think he's got some decent expertise on this. And hopefully, we'll get some good insights on what to look for, what to avoid, and what to expect over the next year or two as Trump takes office. And then at the end, as we usually do, I'll be running through some market slides to try to give you some ideas on the upside, downside, risk, and potential rewards. Thank you again very much, and I'll leave it to John. John?
Okay, thanks, Gerry, and welcome everybody. So this is our 2025 outlook. I'm going to look really at four questions. First of all, I'm going to look at where are we now in terms of the economy, and then I'm going to address the questions that we advertised. Will Trump be good for global equity markets? Is rising government debt about to become a problem? And what does Trump mean for the US dollar? There's a whole lot of other questions out there, and we can come to that later if you want. But I think it's interesting to focus on these to begin with. So where are we now? I've shown this chart a number of times. It continues to amaze me how strong the US economy is compared with the UK and the Eurozone. You can see the US powering along. The fourth quarter GDP estimate is running at 3.2% for the fourth quarter. So another strong quarter in prospect. And meanwhile, the UK and Eurozone have basically been pretty static now for the last couple of years. Very poor performance. So why is the US so much stronger? And I think it's important to understand this. Obviously, it's helping to drive the stock market's difference as well. Part of it is on the demand side and part of it's on the supply side. So if we look on the demand side, obviously the US had a much bigger fiscal stimulus during COVID and after. Biden continued with big new fiscal packages. The US savings rate, household savings rate, has tended to be lower. It's lower now than it was pre-COVID, whereas in the case of Europe and the UK, it's higher. I'll show another chart on that in a moment. But obviously that means that consumer spending has been much stronger in the US. The US didn't have the same Ukraine war shock. It was particularly big for the UK with natural gas prices higher, but also hit Germany badly with parts of the industry actually having to shut down. And Germany's also been hit by the China shock, a big reduction in exports to China of cars and machinery. So that's had a big impact too. But I think what's more interesting actually is on the supply side, why has US productivity growth been so strong compared with Europe and the UK? And that's still something that we're struggling to understand. One reason does seem to be that the US had this big job shakeout. People were simply made unemployed, paid higher unemployment benefits during COVID. Then when they came back to jobs, they often came back to different firms or even different activities. Many people did retraining. Whereas the UK and Europe did the furlough system, everybody came back to the same jobs. You just didn't get that improvement in productivity you can get when people move to a firm where they're better placed or firms get rid of low performers and so on. Another reason, though, probably is simply that the US economy has been running hotter because of that stronger demand. And there's quite a lot of evidence that an economy growing strongly with strong demand generates higher productivity. And the third reason I would point to is that in the US, it's particularly the technology and also the energy sectors that are leading the way. And the tech sector, of course, is not highly regulated in the US, and I think that gives it a lot of freedom to move along. But the US has this much bigger tech sector than Europe and the UK, and that's been where the growth has come from. So I mentioned the savings rate. This is showing the savings rate in the Eurozone, UK, US. You start with the US there, the red line. You can see how it's lower than it was pre-COVID. And that's helped to keep spending going. Compared with the UK, where the savings rate is over 10% now, whereas it was close to 5% pre-COVID. That's a big difference. That's 5% of spending disappeared because consumers are being cautious. And there's 2 or 3 percentage points in the Eurozone as well. Why is that happening? Well, it's not because of unemployment, which is low in all three areas. I think it has to do partly with asset prices. So house prices in the US have carried on up. They're very strong. And also stock prices in the US are strong. Not true in the UK and the Eurozone. Also, obviously, the oil shock, sorry, the energy shock was much greater in Europe and the UK, so that's affected things. And then I guess the sense of angst, the political issues in Europe, UK, has been different to the US. Now, obviously, the big issue the last few years has been inflation. And the good news is that it's come down. The bad news is it hasn't come down all the way. This is core inflation. You can see it's looking a bit sticky around about 3%. Now, the good news here is that wage growth still seems to be coming down in all three areas. And so central banks are looking at this, and wage growth needs to keep on coming down. But there is a good prospect, I think, that inflation does come down to 2% over the next year or so, probably faster in the Eurozone. UK is perhaps the biggest risk on this, but it does look reasonably promising. But that's certainly something the central banks are going to be watching. They're being a bit cautious at the moment, cutting rates only slowly, waiting for this last bit of inflation to come out of the system. So are we likely to see higher confidence in 2025? It's obviously been very low this year. You still have unpopular governments in the major countries. We've got tighter fiscal policy in prospect. UK is a bit of a strange case where the budget seemed to be loosening fiscal policy near term, but now people are wondering about that because business took the budget so badly that it may be that there is no net short-term stimulus there. France is trying to tighten fiscal policy. We'll see how that goes. Germany may be different. They want to get rid of the debt brake. I think that's probably more of a 2026 story, though, frankly. So we're likely to see tighter fiscal policy. What I think will support Europe next year is lower interest rates. We should see further cuts in interest rates before the end of this year and also through next year. We might see an end to the Ukraine war, or at least a ceasefire there, which will be good news. The big uncertainty, though, this brings me back to Trump, is tariffs and what will Trump do? So, Trump policies, there's a lot on this chart. Let me try to go through it. On the left-hand side is a list of the things he's talked about in the campaign. And then the first column, which says short-term demand, that's the impact on demand in the short term. Now, if for example, he reduces regulations and that leads to an increase in spending, increase in investment, that's an increase in demand. Of course, one of the implications would be that the Fed could keep rates higher for longer. So we have to bear that in mind. And the right-hand column is trying to argue what it means for long-term productivity growth in the US. So if we take them one at a time, reduced regulations, I think this is the one that I'm probably most hopeful of for the US. I think reduced regulations, Trump will do this. He has a lot of scope through executive orders. From what we can gather, he's drawing up a whole long list of executive orders which are likely to be implemented on the first day, or at least the first 100 days, which could make quite a difference. It will strengthen demand short term, I think. It should also help with long-term productivity. So the second one is business tax cuts. Now we have to be careful here because the US government, the Congress, is going to be spending a lot of time next year talking about tax. But at the end of the year, there may be very little difference to tax rates. And that's because what's supposed to happen is that the tax cuts of 2017 are supposed to expire at the end of 2025. Expectation is that Congress will essentially spend months and months next year deciding exactly how to keep them more or less the same. So there might not be much change overall. We'll see. Trump has talked about cutting the corporate tax rate from 21% to 20%. He's also mentioned 15%. If he does that, that will support demand and I think support productivity in the long run. He's also talked about cutting business taxes, corporate tax for companies that are producing in the US. I'm not quite sure how that would work, but that also could have an effect. Third item he's talked about, lower taxes on tips and on social security payments. I'm not sure that's going to go very far. We'll see. If he did do that, it would certainly strengthen demand in the short term, really no impact on productivity. Pressure to reshore, again, exactly how he would do this is unclear. It might just be telephone calls to big company executives. The short-term effect is to increase demand in the US if you start building a factory in the US. And I should say here, by the way, this is actually not a new policy. This has been big under Biden. There's been huge spending on manufacturing facilities in the US under Biden, more than for many, many years. It will probably increase, though, under Trump. The effect on productivity, though, I think is down net. These things are being produced outside the US generally because it's cheaper. Start producing in the US, that's inefficient. Deportation of illegal immigrants. Again, this is not entirely new. It's been going on forever. Trump has been talking about far greater numbers. If he does that, it will lower demand in the short term. The effects on productivity, uncertain, I would say. We could get into that if you want. Then there's the whole plan to lower government spending. Now, some of that could be getting rid of some of the subsidies for climate change transition policies. We'll see how far that goes. Some of it is the Department of Government Efficiency, Musk agenda. That would obviously, if it went ahead, that would lower demand in the short term. I think it would probably raise productivity in the long run, although Gerry and I have discussed that. Obviously, it depends exactly what spending you cut, and it also depends what you do with those revenues. Then there's tariffs. I think it's very clear that would lower demand in the short term. It's basically a tax on American consumers. It would also lower productivity. And then more broadly, unpredictability. I think this is a negative for the US, short term and long term. So a lot of stuff in here. We really don't know exactly what he's going to do. We'll find out. The people that he's nominated for various jobs. Scott Bessent is obviously the most important person there. Nomination for Treasury Secretary. He's not a fan of tariffs particularly. He's also a fiscal hawk in principle. So he's probably going to be trying to restrain some of Trump's instincts. But we'll see how that goes. How does this all work out for equities then? What's the overall effect? And it's very hard to know. If we assume there is a restrained use of tariffs, and this is obviously debatable, he has talked about tariffs of 60% on China, 20% on the rest of the world. But let's assume he actually uses them in a reasonably restrained way, making threats, promises, trying to negotiate around them. Then I think broadly, the overall policies, including the tax cuts, the spending cuts, I think it's broadly supportive for the US economy. It means higher economic growth, both short-term and higher productivity. But it also means interest rates staying higher for longer. So for some time, we've been arguing that something like 3.5% may be the sort of terminal level for the federal funds rate. But we may stay higher than that for longer than we had thought, simply because you'll have this stimulatory government policy. What does it mean for the rest of the world? Well, I think that the whole tariff thing obviously leaves them vulnerable, and also the uncertainty. If you're a company exporting to the US right now, what do you do? It's very difficult. I think, though, that the backdrop in these countries, Europe, UK, Japan, is actually better than people realize. We are looking at declining interest rates. We are looking, I think, at an economic recovery. The Ukraine shock is past, hopefully. Energy prices, although they've come up a little bit recently, are much lower than they were during the shock period. Inflation has come down. And when we look at stock markets, you have reasonable valuations, especially compared with the US. What happens if Trump goes all in on tariffs? I wrote a blog a couple of weeks ago arguing there's a risk of a DIP, disruption. It'll be disruptive because companies will be struggling to change their supply chains. It will be disruptive also because most countries will retaliate, at least in part. It'll also raise inflation, which will create issues for central banks. My guess is that they will tend to look through it because they'll see it as a one-off effect. Nevertheless, they're unlikely to cut rates if inflation is jumping up to 3.5%, 4%, 5%. It'll lower productivity in the long run, so it's definitely bad. And dip in the sense that it does mean slower growth everywhere. So we have to hope he doesn't go this route. The worst affected countries would be China, because we're talking about 60% tariffs, and Mexico and Canada, because their economies are so integrated into the US. Big part of their exports goes to the US. But Europe would suffer, and of course the US would suffer too. It's bad for the US. So we have to hope that Trump doesn't go this route. Let's look at valuations. And this chart is from Yardeni Research. The pink line at the top is what he calls the mega cap 8, which is basically the Magnificent Seven. We all talk about the big tech companies. Plus, he's also included Netflix here. You can see how that pink line really departed from the others back around 2017 or so. And obviously, the valuations there are significantly higher. Obviously, earnings growth is higher as well. If you look at the red line, which is the 500 index, including those 8, you can see it looks pretty expensive. We were at the same sort of levels in 2020, but obviously interest rates were much lower. It's not quite as high as it was back in the bubble period of 2000, but it looks pretty expensive. If you look at the mid and smaller stocks, they've come up, but they don't look too expensive. They were pretty cheap back in 2022, 23. We went overweight for a while. We're back to neutral on these now. I think they were cheap, I think largely because everybody was talking about recession at the time and they would have suffered. But right now, they don't look too expensive. So that's a positive area. What this chart does is look at the overall 500, which is the blue line here, same as we saw last chart. But then it's looking at the median stock. So it's the 250th stock, if you like, in that list. And you can see it's lower. It's still pretty high, though. So it isn't just the top 7 or 8 stocks that are expensive. It's other stocks as well. Now, a lot of people are talking about bubble. And I do worry because there's obviously an enormous amount of enthusiasm at the moment in the market. A lot of people are arguing it, it'll keep on going up. It's a no risk investment. There's a lot of interest, a lot of activity. This is quite bubbly. On the other hand, I look at this level and I think, well, the outlook is pretty good, actually. You can see why people are comfortable holding stocks, at least for the near-term outlook. The economy is growing quite strongly. There's a prospect of lower corporate tax rates. You would expect that the stock market to be reasonably expensive at this point. It does raise the question, though, of how much value there is, especially for the longer term investor looking to hold for 5 or 10 years or more. And you can come to the same argument looking at the cyclically adjusted price earnings ratios. So this is taking 10 years of earnings, adjusting for inflation. US is expensive. Again, not quite as expensive as it was in 2000, but pretty expensive. Now, you're looking at 10 years of earnings. So if you've got strong earnings growth, as the US has indeed been having, then naturally you're at a slightly elevated level because earnings 10 years ago were a lot lower. Things have moved up. Margins have moved up, earnings have grown. Nevertheless, this looks pretty expensive. You can see in contrast, the EU and the UK look more reasonable. UK actually looks a little bit on the cheap side compared with its own history. And you can get into this in greater detail, look at individual sectors, compare stocks. The general overall impression is that the stocks in Europe and the UK basically the US has a premium over those when you compare stock by stock or sector by sector. And just briefly, to the other important markets, China is still cheap, and that's probably for a good reason. We can come back to China if you like. They are doing some more fiscal stimulus now. There has been slightly better economic data the last month or two. We're still not very optimistic, though, on China. India is a very good economic story, but the stock market is already expensive, and I would use the word bubble there. That doesn't mean it's about to collapse. It's had a correction recently. It could still go higher. I use the word bubble because if you take a rickshaw in India, apparently the rickshaw driver will be telling you to buy stocks. So I exaggerate, but that's sort of where we are. So I would worry about that. Let me turn now. I know we're running low on time, but I want to talk briefly about the question of government debt. So this chart shows the net debt as a percent of GDP. Of course, with COVID, it jumped up just as it jumped up during the global financial crisis. Governments tend to spend more money, have big deficits, and then unfortunately, in the good times, they tend not to actually reduce the deficit enough to bring debt down. There are exceptions. Germany is not on this chart. That's because Germany actually did cut its debt ratio significantly during the 2010s after the financial crisis, but other countries didn't. So basically, we have net debt ratios around 100% of GDP or higher in these major countries. Unfortunately, deficits are still quite high. So the red bar here is the forecast for 2024. US on the right, you can see over 6% of GDP, very high deficit. But UK, France, Italy, Japan also with high deficits and all higher than pre-COVID. Now, in the case of most of these countries, ex the US, some justification for that would be low economic growth. That's not the case in the US, where they've had strong growth, but they've still got a big deficit. A lot of pressures on budgets, clearly. You've got aging, health, pensions. Defense spending is a new one. You've got immigration and asylum costs, which are expensive. By the way, if Trump does go for deportation, that's going to be expensive too. Higher real interest rates. So we're looking at probably interest costs rising by between 1 and 2 percentage points of GDP compared with 2019 over the next few years. That's a pretty big cost for governments that they're going to have to be paying. It'll obviously rise gradually as debt runs off, but it's quite significant. Arguably, we're reaching the limits of tax. That's been argued in the UK, maybe in France as well. And then you've got the slow growth. Unless economic growth changes, it's very difficult to manage budgets. So enormous pressure here. There's some risk of a crisis. Obviously, people are looking at France at the moment. I think the broader risk, though, is that bond yields rise and yield curves steepen as a result of this. We had pretty flat yield curves for most of this century so far. I think that may be changing now. So it's going to be interesting to see how that works out. And then finally, I want to talk about the US dollar. So US dollar's already expensive. This is the real effective exchange rate, so it's adjusting for inflation. Get this data from the Bank for International Settlements. And you can see how it's at high levels. It tends to go in these long swings lasting 8, 10, 12 years or more. Up in the 90s, down in the noughties, up in the teens, and now it's at high levels. Our view on currencies has been when you get to these high levels, at some point you're going to come down. Obviously, it depends on relative interest rates, which depends on relative growth rates. Since Trump was elected, the dollar has actually done well. And that's because the expectation is that Trump means faster economic growth, means higher interest rates for longer, and potentially Trump could lower growth elsewhere through tariffs. So the dollar's been strong. We tend to think that there will be a turnaround here. Not to say that the dollar is going to collapse, but that it's due to fall back. And if you look at the pound followed the dollar all the way up to Brexit, and then basically change levels anyway. Big drop in the pound. It has been trending up more recently, but it's still at a much weaker level than the US dollar. So to conclude on the economics, before I hand over to Gerry, I mean, you can take an optimistic view. You can say, well, Trump is not going to change things too much, or actually he could change things for the better. Could be some deregulation, lower taxes. And so US economic growth will continue in the sort of 2 to 3% range. He won't upset the Western alliance too much. NATO carries on, the US stays in the Pacific. So things don't change all that much. It's kind of what happened in Trump 1, if you like. And then on the optimistic side, you can say, well, we've been worrying about inflation for 3 years. Well, that's done, inflation should come down the last bit over the next year. Interest rates should come down. There's even a good prospect that the wars in Ukraine and the Middle East go away next year. And that would be good. It would help, especially on the oil price front, worries there. You can also, and this is a different area really, but you can also make the case that AI and robotics are going to generate big productivity gains. This is obviously a little bit longer term. I'm actually an optimist here, but we'll see. It obviously depends on actually adopting these things as well as inventing them, but we'll see how that goes. You can also take a pessimistic view, and you can say, well, Trump is just going to create so much trouble with his tariffs and his unpredictability, and that's going to slow economic growth or even create a recession. Maybe he'll actually, an alternative view is that he will create such strong growth that it actually rekindles inflation, and then the Fed actually has to raise rates. I think that's unlikely, but it can't rule it out. And then on the geopolitics side, things could go wrong there. Maybe Trump steps back too much. Maybe we get more issues on the geopolitical front. Now, my personal view is towards the optimistic end. I have argued, though, as you saw, that US stocks are already quite highly valued. Our allocations are pretty neutral at the moment, but we are nevertheless watching this one very carefully. And with that, I'm going to turn to Gerry.
Hi, everybody. Just a quick video of me, so you can see it's actually me, not some AI-generated smart robot, unfortunately. I'm going to kill the video, otherwise I get distracted. And let's launch into where we are and what could happen next. The first slide, thank you, John, is that a snapshot of where the markets were a couple of days ago, and the bits in yellow on the equity side are highlighting the big returners. As you can see, the US over the last month was pretty good. Small caps got a big boost from the election result. You can argue some of it was getting a quick result. A lot of it was hope that Trump is going to be, like John said, going to be negotiating a lot of good things rather than enacting a lot of bad things, he says, to sidestep some minds here. And the yellow basically says, if you're invested in the US, you got good exposure to tech through the NASDAQ, you've done pretty well over the last 10 years. It's that simple. And the blow up on the right is the US sectors. And this just highlights the obvious, which is tech has done well. Remember, consumer discretionary has Tesla, and technology, 5-year, 10-year gains are pretty eye-poppingly good. Financial services did well over the last month, which is a reflection of a couple of things. One is hopes of lower regulation. Two is, as John said, hopes of a steeper yield curve, it seems. And of course, communication, that's where a lot of the tech shares have been lying as well. They've done well over the last 12 months and over the year to date. Next slide, please, John. Okay, this is a semi-log chart monthly of the S&P. We are all familiar with the index. We all know that it's been a big up bull channel for a long time. We've been using this chart ever since we launched Tricio to explain why we are so boring. We say basically either overweight or neutral for the most part for the US large caps. And that's because we don't really see a huge reason to get worried until now. Now, let's get worried because we are not that far away from the top of the channel. Last time we were up here was 2021, and you can see that we kind of fainted, faltered, swooned, whatever you want to call it. We had a correction that was pretty meaningful for 2022. Could the same thing happen again? Of course it could, right? Which is why we're going to be watching US economic outlooks. We're going to be watching the Fed. We're going to be watching what happens with Trump over the next few months and well through 2025, it seems. So right now, we're happy, we're neutral, we're going to be bumping into the top of the channel. We can obviously work above it, that's fine, but it's the levels like John pointed out in his PE charts and valuation outlooks. We are at pretty good levels here in terms of extreme. Next slide, please, John. NASDAQ. This is where a lot of the high-tech shares lurk. New highs, fantastic, bull channel, looking good. Top of the channel is miles away, great. However, we are going to keep an eye on this because there's no reason why we can't mean revert back to the red line, which is 12-month moving average. And in a worst case scenario, we could come down to the bottom of the channel, quote unquote, still being long-term bullish, but that's still a hefty, I think it's more than 15% correction. So it's one of those things where, yes, we're quote unquote happy, but yes, we're lofty levels. We're in the middle of a channel, so there's not a huge amount of support. of any huge importance nearby besides the 12-month moving average. So that's a 250-day moving average. You want to look at it that way. It's one of those things that we will keep an eye on as a barometer for further losses and the view that a correction can turn into a bear market sell-off if things go bad. So right now, as John said, neutral, positive. Let's emphasize the fact there, John. It's new highs are good, but we are exposed in the middle of the channel, right? Next slide, please, John. Russell 2000, the S&P 600, that could be a much better index, but we still look at this one, historical reasons. Everybody knows it. Lots of ETFs are tied to it, all those things. Right now, it's looking great, and let's see what happens. It's one of those things where the upside is very positive from here as far as the bull channel is concerned. It's a hugely wide channel, of course. And again, we're using the 12-month moving average, 1-year moving average, or whatever sort you want to look at, as the corrective support level to hold in order to maintain our neutral, slightly positive outlook here. If we start sliding below that red line, things get a bit dicey. I mean, it could come back to the flat red line, the horizontal one, as support, which is still above the bottom of the channel. So again, positive. We like the upside, but we are worried. Next slide, please, John. FTSE 100. Disappointing is probably the best way to look at this. Yes, we did bump above 8,000. We were looking for that for a long time, but we haven't really moved away. So it's one of those things where you look at this and you can't come up with big reasons to be bearish. And you're thinking, okay, positive outlook, Bank of England's cutting rates. They probably have more rate cuts planned out, next year and stuff. But the index itself is not motoring higher. Now, there's lots of reasons for this. And who knows, maybe Games Workshop coming into the index over the next few months, which everybody's expecting. Maybe that'll happen. Maybe that'll kickstart the index on the way higher. I don't know, he says politely. So it's one of those things where, yes, it looks good. We really need to start working away on the upside, moving away from that horizontal red line, and hopefully aiming for 8,500, 9,000, try to get some traction on the upside here. Next slide, please, John. FTSE 250. This is a mid-cap to small-cap shares in the UK main market. And again, it's one of those things where we are positive overall. We have a neutral allocation, but it's one of those things where the chart is saying this is not performing as well as other market indices, other market sectors, and it's underperforming. It's one of those things where you look at it and go, okay, at some stage it quote unquote should catch up. There's a market phenomena where we prefer small caps and mid caps because they have higher risk, high volatility, and in general are supposed to outperform. This has not happened so far, and it hasn't happened in a while. So yes, hopefully we get support. Hopefully we don't break below the bottom of the channel, and hopefully we meander back up to the rising red line, and the top of the channel is miles away. So there's tons of upside potential here. But the key word in all that was hopefully, which is really not a great way to invest. Next slide, please, John. Japanese market, we look at the topics, and we came up to the big levels from the late 80s, and we kind of stalled out. We're still relatively supportive of this market. We like it. We're at neutral allocation. We think it's going to break higher at some stage over the next cycle, in this cycle. So that means next year or the year after. So we're still pretty optimistic here, and there's no signs of a major reversal yet on our view. Next slide, please, John. Now, this is the Stocks 50, the Euro stocks. Again, we are supportive here. It's nice to see it breaking higher. We are obviously watching the all-time highs here, which are not that far away anymore. And hopefully we break higher over the course of this cycle. Lower rates should help. Political turmoil needs to be sidestepped. Higher bond yields wouldn't help. But that's, again, on the obvious side. Right now, we're positive, but we need to see some upside traction start to build again. Next slide, please, John. Now, let's look at bonds. And I'm just going to focus on the U.S. bond market for this webinar, given the fact that we're talking about Trump and what he may or may not do. So right now, we saw bond yields fall away from 5%, dipping down to around 3.6, right when the Fed started doing their jumbo rate cuts. Since then, U.S. economic data, as John pointed out, has been strong, and we saw yields back up. Yields backed up a bit more after the election. Everybody tried to think about what Trump means for inflation. They thought it meant 4.5 yields. Then they thought it meant 4.2 yields. So it's somewhere in there might be the answer. It's one of those things where we see what happens. But as far as the chart is concerned, the fact that we stalled at 5% is pretty important. What we need to do is see a break below 3.6 to give us some more swagger for 3.2, 3.0, 3%. target area that which we think it will go to. At an extreme, you could argue for US bond yields heading towards 2.5. We don't think it's going to happen that fast, if it happens at all. And our view is bond yields will probably, if we're lucky, come back down to 3.6, and they might drip down to 3.5, 3.3, 3.2. And that's where you probably might see them base out a bit if we're lucky. If we're unlucky, you're going to see bond yields start breaking above 3.5 on a sustained basis. Sorry, 4.5 on a sustained basis. And we're going to start seeing a move back towards 5%, which is where they peaked out in the cycle before. Now, if we start breaking above 5%, I can talk to you about 5.3 being important, but we all know that's the flat red line, the horizontal red line. But we all know the market's going to be looking for 6% because they like big round figures. So it's one of those things where if we start giving up on 5% on a sustained basis, we've got to be start to think about 5.3, 5.5, obviously 6% and higher. We're not leading that way yet, but we do think the coupon curve is going to steepen. Now, the coupon curve is a line that is a chart on the bottom of this one, and you can see that we were well below zero. We're at negative levels. I think we probed 100 basis points, negative 100 basis points a couple of times. We've come back up. We haven't really broken that sharply above the zero area, but in our view, this should move towards 50 basis points and maybe 80 basis points on a positive level. You could argue for a much higher or steeper coupon curve, but right now we think 50 to 80 basis points is a reasonable target. So that would be short end moving towards, like John said, 3.5, long end sticking around 4. Now and then we see the dash towards 3.6, but doesn't stick. So you see the 10-year yield basically trade in a range between, let's say, 4.3 to maybe 3.3, whereas the 2-year yield drifts down to 3.5. You might see a dash to 3.25, then it comes back up to 3.5. It'll meander around a bit. So that should give us the steeper coupon curve if we get the math right. Next slide, please, John. Now, here's one of the bigger risks that we see in the market. And we've been arguing for lower oil price for some time now, and we continue to argue for it, mostly on supply and demand factors. So right now, we're finding good support. This is the ICE Brent contract, front-month contract. We're finding really good, strong support every time we get towards 70. That may persist, but there is a slight chance that with Trump's drill, baby, drill mantra, he basically curses the oil industry and the oil price goes down towards 60, towards 45, which is where we have our targets, $45 a barrel. And that's going to basically be, quote unquote, good for consumers, good for everybody who uses oil. It's going to be pretty bad for companies that produce, drill, explore, sell, and basically rely on higher oil prices to make a lot of money, which is why I think you've seen some of the pushback from leading US oil companies saying, look, we're already, getting as much oil out of the ground as we want effectively. But you never know how it's going to pan out. As John said, if we get the surprise of peace breaking out in the Middle East and in Russia, Ukraine, then you could see more oil hitting the markets. And again, on the supply side, that would probably put some downside pressure on the prices. We'll be wrong if we start seeing sustained gains above $80 a barrel again. And obviously the flat blue line is worth watching. That's just below 90. And it's one of those things, if we start seeing sustained gains above there, then you can start making ideas about 120 again, 140 again, which we don't think is going to happen unless you see a major disruption of supply. Next slide, please, John. Now we put gold in here mostly because we don't really ever agree on what to do with gold. It's one of those things where James, if he was here today, and he sends his apologies, but if he's here today, he'd argue that gold should be a decent part of your portfolio. And we argue about what decent means, 10%, 5%, 1%. I am on the record as saying I think gold watches, gold rings, jewelry, that's fantastic. Gold bars, why not? Have them in your basement. Gold certificates in case the world ends won't do you much good, he says politely, because you won't have electricity. The world is ending, right? So if you're going to have gold as I need something in case the world ends, I would say keep physical gold and, good luck. In terms of chart analysis, it's a bull trend. We've made new highs. We are not mean reverting. I always think that, high prices cure high prices in commodities. This has proven me wrong. It's proved me wrong for the best part of a year and a half now. So I do believe at some stage gold prices will mean revert and we'll see 2000 again. However, there is not much technical evidence for that on the chart. It's one of those things where it's bid. Everybody has a reason for it, and it could continue to remain bid. and it could continue to be very expensive. It could climb some more. And thank you to the audience members for joining us. If you have any questions, please email them to us. You have our email address. If not, info@tricioadvisors-advisors with an L.com, and we'll be happy to get back to you. Once again, thank you for joining us in our webinar. And we wish you the best of the holiday season and the new year, right? We have Trump to look forward to. Thank you, everybody. John,
Thanks,
thanks.
Gerry, and thanks, everybody. Happy New Year.
Happy New Year.